This is Brad the Humble Trader. If you're seeing this video, then my computer is finally working again. I haven't done a video for a couple of weeks, but I'm hoping they've sorted this problem out. I usually do the video on the weekend, but I think we're at a pretty critical time in the moment in the market, so I just want to show quite a few charts to show why I'm really bullish. There's a few caveats on that which I'll show, but I'm very bullish, and I think there's a really good opportunity to get into the market now, at least going by the things that I look at, which I'm going to show. But like I said, there's a couple of things just to be wary of, but yeah, I think this is a really good time in the market. I think we're going to have possibly a very good run into the end of the year, or at least for a couple of months anyway. So I'll get straight into the charts, and we're going to start with a couple of things just to be wary of. There are a couple of indexes which are lagging, which is a bit of a worry, and that being the transports and the NASDAQ, or the composite, the NASDAQ composite. So what I just want to show is just, with the NASDAQ, particularly the transports, it's at the moment it's still underneath the 30-week moving average, and the 30-week moving average is pointing down. So I wouldn't trade the transports right now. That goes against Stan Weinstein's methodology. So this is a little bit of a concern, as is the CompQ this week's had a good run. So in fact, the 30-week moving average has turned back up again, right? So this is actually close to a breakout, which it's potentially a very good trade. But there's a few strong indexes which are standouts, and for me, pretty much tradable right now. So I'll just show you why. So with the RUT, or the IWN, which is the ETF of the small caps, it's just about to break out now. Not so much this week, but possibly next week. This is going to be an excellent entry. If you're bullish like me, then that's an exceptional entry. Because if you look back at the past times that it's broken these big resistance levels, we've had a good run every time. Now you've got to remember that this level down here, this sell-off, even though in terms of percentage-wise it wasn't that big a sell-off, in terms of extreme sentiment and even breadth and so forth, it was quite an extreme sell-off. So that's why a few weeks ago I was relating, or when I was looking at my back testing, I was just looking at the price action in comparison to the 11, the 2010 and the 2009 bottoms, because those three bottoms are fairly extreme sell-offs, or at least in terms of, like I said, sentiment and so forth. So, and there are very good similarities between particularly the 2010 2009 bottom here. 2011 is a little bit different, but regardless, when you look at the breakout of resistance, whether it be a smaller one like the 2011 or 2010 2009, if the price is above the 30-week moving average and it's rising, you want to stay on that trend, and you're going to get yourself some nice profits regardless of these small pullbacks. And that's the thing, it was just such a strong run up that it leads me to think that this is going to be the case. Now that could change at any time, sure, but you've even got a good place for your stops. That's why it's a nice low risk entry point. Have your risk at your tolerant level, but you've got a good place to have your stops. And if the price comes back down and breaks that, then sure, you can get straight back out again, which is a possibility. But regardless, at the moment, like I said, the reasons a few weeks ago I showed why I'm bullish. The 50 EMA is over the 100 EMA on the daily charts, which is it's an uptrend. the weekly 30-week moving average is rising and price is above. Okay, it's just, I mean, you really needed to break resistance here, which is probably going to next week, but once that happens, that's as good as buy as you can get. I mean, we've got participation, we've got the on-balance volume and the accumulation, which is positive. And then, but what I want to show is, if we have a look at the Dow, what I want to show is why I think this week in particular is a very good week to buy. I mean, you can wait a week for even more confirmation, but because we've got double, see the double trend lines here. I did the thicker line as the first one in each case because I think it's critical. The second one is like a double confirmation, but I'm not worried about that. A lot of people will wait for it to break highs, which is fine. Like I said, it's double confirmation, but for me, I'm in because if you look back when we compare these last three bottoms, each time that it broke this first trend line on the first bar, as long as that resistance is broken, as long as the 30-week moving average is facing up and price is above it, then you've got yourself a good entry. Now, the significant thing about this is the retest of the 30-week moving average. That's why I didn't buy. I actually, above this little trend line, this top here, a couple of times I actually got in on the 1 hour charts just to play around. I thought we were going to have a good run, but I got taken out very quickly because I had very tight stops, because I don't like to trade against the trend, and that's the trend there is down. But up in this section here, above the 30-week moving average, short price was above it, and it was rising, which is certainly two of Stan Weinstein's methods, things that he needs to trade, but it wasn't above the resistance there, and there's no way I'm going to trade that so close to resistance. So once it broke the resistance, I thought, no, well, that's good positive price action, but at that point it was so overbought, there's no way I was going to enter it right up there. Luckily I didn't. I was expecting a short-term pullback, which it's had. And this is what I've been waiting for, and like I said, it seems to be quite a good setup. So we've come back down to retested the 30-week moving average, which is great, and we've had a positive week. So if we go back here even, at the bottom of the 2009, you've had a break here, and then it's popped above it, and then it's had a retest, and, well, in this case, a break of the 30-week, which would have, tossed a lot of people back out of the market, or a lot of short covering, I guess. Sorry, it would have been long covering. Sorry, and then basically you got your good trade there. But in these two instances here, similar sort of thing. Once it breaks that first resistance, people would have got in. Then we've had a bit of a sucker, a profit taking, which is popped below the 30-week moving average. I mean, if you hang on there, fine, but a lot of people would have got taken out or scared out probably there, and that would have been a great entry there. Same thing. So basically what I'm just trying to say here is the retest of the 30-week moving average. Having that 30-week the moving average and then price breaking that resistance, that's really the perfect setup. Same thing after 2011. It's broken that first resistance, come up, and then it's retested, and then we've had that next run up. So we've had the break and we've had the retest. Okay, and each of these instances have shown that if you get on that first positive day, this is a weekly chart, after the retest of the 30, then you've got yourself a good trade. Now, I'm not suggesting get in here. I'm suggesting sort of get in after the next resistance level is broken, which is what a lot of people will do. I'm just saying get ready because I think that's probably going to happen. So let's just go through. I mean, the same thing with the SPY, the S&P 500. Very similar chart. A lot of people are going to wait for the break, which is absolutely fine. But you see, every time this 30-week moving average, every time the price gets down to this 30-week moving average, it's a pretty good buy. The green circles show each time. in a strong run, which I think it's going to be, and that's a pretty good time. Never buy up where the Keltner, the top of the Keltner channel. You should be in before this happens and let it run, and then buy each time that it comes back down to the 30-week moving average. Okay, so the New York the New York Stock Exchange. And keep in mind too, on all these charts, we've had quite a lot of bullish volume too in this run up. So, but anyway, I think the New York Stock Exchange, which I think is the actual market, it's got a lot of the high cap stocks, and it's over 2,000 stocks. So it's definitely a better index to look at than the Dow, and even the S&P 500. But the S&P 500 is widely used. But if you I think we've got a really good setup. We've got that first run up, we've got the retest, and again, because it sold off more than the other indexes, we're nowhere near the high. But there's no way I'd wait for it to break the high. The fact that if it breaks this resistance right here, which it hopefully will in the next week or two, then I think there's a very, very good trade. But anyway, just quickly, I want to go through the daily indexes of these. The daily charts of these indexes. Another way I use the daily charts as entry points is using the Keltner channel and using the 50 over the 100. So right now, the trend is up. If the 50 is over the 100, then the trend is up. If it's below, the trend is down. So I won't trade in a down market. I won't go long. If these are crossed down to the downside, I won't go long. And right now, I won't go short because while the 50 is over the 100, the trend is up. So again, if you look at each time the 50 is over the 100, and each time after a correction that resistance is broken, you get yourself pretty good setups, opportunities. Now that's where we're at now, and this is the transports. Keep in mind, the transports is actually the weakest of the indexes, which is a bit of a concern. And also the 50-day moving average is facing down, and for that reason, I wouldn't trade it even on a daily chart. Like the 30-week moving average, I would only trade it if it's above the 50-day moving average, and the 50-day moving average is facing upwards. Okay, like in all of these instances. Okay, 50-week moving average, day moving average is facing down, but once price broke the resistance, it's facing up again. The fact that the trend is up, that is a good time to buy. And once again, buying at the top of the Keltner channel is not a good idea. Each time that the price broke down in a correction, it came down to the bottom of the Keltner channel almost every time. And in fact, this is a line chart, so this is closing price. But if you saw intraday price, or the low of the day, then more than likely it does in most instances. So once you get the Keltner channel down there, I wouldn't suggest to buy down there in case the price breaks down. But once it breaks a resistance level and the 50 points back up, then why not? It's a good entry. So I just want to show. So the transports right now is not a good trade. The Nasdaq is actually a bit of a false break here, but the trend is back up again now. We're coming up to a bit of a significant resistance there. I wouldn't sort of get into the Nasdaq until it broke that resistance, but once it does, that's a good trade. The Dow's looking very good. Dow had a perfect three-wave correction down to the 100 moving average, down to the bottom of the Keltner, and it's just broken that a second time, broken the second resistance. I mean, it's perfect. You don't get much better setup than that. Low risk. You've got your stop underneath this low. If it breaks, then you're out. Same here. That the RUT is, or the small caps, very close to breaking this line here. Once you get break there, that's in my mind a great trade. The SPY. Now I showed a few weeks ago what I was looking at. This is 3 weeks ago. Yeah, it was, because the pullback was 22 days. So I showed how the comparison between the 2009 bottoms and the 2010 bottoms, how they were very similar. So the retrace or the correction in the 2009 bottom was 19 days. The correction in the 2010 bottom was 16 days. So and we had a Fibonacci retracement of 23.6 and 23.6. So going off history, I was saying that we should have or could have a retracement about 23.6 fib retracement, and then a three-wave pullback approximately between 16 and 19 days. Once it breaks there, great entry. So this is what do we? It's 2000. Yeah. So that's the other. So this is the chart that I drew this 3 weeks ago, and I haven't changed it except I've changed this days to show how many the pullback was. I said history suggests between 16 and 19 days, and it ended up being 22 days, which is close enough. I drew this picture here to show what I'm looking for. At the moment, if you can see through here, we've had a three-wave pullback, and I said I thought it'd get down to the 23.6, which it got exactly down to the 23.6 or near enough. Probably break the 50, which it's done, below the 50, in between the 50 and the 100. And once it breaks this line, then that's a good entry. It's exactly what's happened right now. I mean, yesterday. Or the day before, whenever it was. So just a close-up on that. So I've just done a close-up. I mean, what I was saying also was there could potentially be a little head and shoulders here. It did look like it, which would take it down to around about the 38.2 retracement. But I was also saying if it's the correction like those last periods in 2009 and 2010, then I put these speed lines here, which would take it to around about the 100 moving average. Didn't quite make it, but it was close enough. You've always got to look at both the possibilities of bearish and sideways or bullish, but these are the things I was looking at, and it's happened just that way. Also, my volume indicators at the moment, we've got what do we got? We got 1, 2. The money flow is just about to break, so that'll be 3. We got 4, 5. We got 5 out of the 7, and these two are pretty close to breaking up too. So once I've got all 7 of those indicators up that have broken their rising above their moving average, then I'm pretty confident that you're following the money, which is what you want to do. Let's have a look at silver. The other week, 3 weeks ago, I showed you silver. I thought it looked like it was going to top out, needed a bit of a correction based on history, which I showed 2009 bottom. It looked very similar. We had 2 waves up, got to that resistance level there. We had 3 waves up, got to the resistance level. Based on the Fibonacci retracements, I said it would pull back possibly to the 62 to 52%, depending on which. I'm going off the whole price action there and that price action there. So that's where we're at now. We've gotten down to the 50, but actually, if we just have a look too, I just drew this trend line here to see, because where we're at now, I drew it. So what happened last time? It did actually, there was a bit of a false break, and then it had quite a complex correction here, which took 3 months. And if I showed you last time that the correction here took 3 months, and it took 3 months. So in silver, in this bull market, 3-month correction is fairly common, at least at that period. So if this turns into a more complex correction, it may take about 3 months, which would take it to August. Okay, that still stands until this is broken and it shows something totally different. That silver could go lower, which would take us to the dollar. The UUP, which is the dollar ETF. All my volume indicators are starting to come down. It's retraced up to the resistance which I had. It's broken a little trend line there. Trend is down, and price has gone back down below the 50 moving average. Okay, so once that 50 moving average points down, that could be another good entry to go short. But I would prefer to see all of these, at least, or most of them, go down before when I say go down, I mean below the moving averages before I enter, which could be any day now. And if that's the case, the silver could just start going, and gold's, precious metals could start going higher again. But I think there's possibly going to be a bit more of a complex correction. Lastly, I'm going to show the bullish percent index, the BPI, the New York Stock Exchange BPI point and figure chart. Now, the reason why this is one of the reasons why I'm a little bit cautious here, even though I am actually I am long at the moment, but this is just one of the things that I think you should keep an eye out on. You can put this up on stock charts. So at the moment we're in a column of those. Now I try not to trade unless this is in a column of X's, or at least if I am, I'm very cautious, because what this suggests is that well, since this correction has 6% of stocks on the New York Stock Exchange have moved to sell signals. That's what that means, and that is a considerable move. It takes 6% of stocks to actually change this back up to another row of X's. At the moment, it's still got a little bit of work to do before that happens. Now, once that does happen, if that does happen, then I'm very, very bullish, so confident to be long, because these moves tend to, if you look at these are the years down here, these moves tend to last months, minimum of 2 months, typically, not always, but typically sometimes 6 months or more. If you see some of these years, it doesn't change much at all. I wouldn't say 6 months, but it can do. But if we have a look at the 2009, just let me have a look. 2009, okay. The start of the 2009 was 13th of July. So if we go to 13th of July of 2009, so if you don't know the point and figure charts, the BPI charts, the point and figure charts, the numbers of the months. So if we where's July? So July is 7. Okay, we got 09 and July. So it actually started to turn down in July, but it went straight back up again in July. So this whole month, all these X's up to the 8th is July. All right, so it's hard to say which one of these bars, weekly bars, it was, but it turned up here. Now, if we go to 2010, first we got 13th of September. 2010, so we go to 9, which is September. So at the start of 2009, and that bar that I showed you was the 13th. Okay, so that got you in right at the start of that run up. Now let's go to the next one, which is 2011, just for instance, and that's 3rd of January 2012. 2012 January. So it actually turned X's before it broke out, which was great. I mean, if you've got X's and it breaks that resistance level, then that's happy days. You're pretty confident getting in there. You're definitely trading the path of the resistance here. But at the moment, we're not, in terms of the point and figure chart, we are not trading the path of least resistance, because at the moment that's in O's, which is bearish. But that aside, I think over the next probably week we're going to have a very, very good entry, which I'll update this chart. But so that's all. Yeah, that's all I wanted to show this week. I'm going to on the weekend I might do how I'm going to have my stops and how Stan has his stops. I might do that over the next couple of weeks. We'll see. Anyway, thanks guys. This has been very long, but I haven't done a video for a couple of weeks, so I had some pretty good information that I wanted to show. Okay, thanks guys. Sorry guys, just remember too, this isn't a trading advice. This is just the way that I see things. Thanks guys. Bye.